All right. Hello, everyone. Good evening, good afternoon, and good morning. Today is beautiful Saturday morning in New York City. It makes me almost forget how much extraordinary phenomena has brought by the pandemic. Unexpected shocks have changed people's lives, changed the economic phenomena and market dynamics. All these changes have completely blown away the conventional wisdom and complicated people's way of making decisions. So let's face it, it's a very, very uncertain time, and making good decisions about the future is very hard. It involves focusing on facts, on evidences, assessing risks, thinking hard about the problems we face. So today's conference and tomorrow's conference program, we promote the nuanced conversations like this one about many, many issues we face today. So I'm Wenjie Zhao. I'm the board of director of TCFA. I'm also the public relations officer for the organization. I'm also a global economist at Credit Suisse. I'm very excited to welcome everyone to join me. Also welcome a distinguished panel to talk about the global economic outlook. Today we have Jonathan Pingle, the chief US economist at UBS. Also we have David Wu, the founder of David Wu Unbounded, an online platform delivering timely analysis of markets, economics, and politics. And also we have James Sweeney, chief economist and chief investment officer Americas at Credit Suisse. So let's dive right into our discussion. I want to start with asking our panelists to describe the unique features of the pandemic-induced recession and the subsequent rebound. Maybe just kind of talk about what surprised you and what impressed you. Maybe we can start with James. Can you kick us off, please?
Okay, thank you, Wenjie. Well, I think the singular feature of the pandemic economy is social distancing and the collapse in services consumption worldwide. I mean, if you look at the US and you look at real services consumption going back to World War II, you'll get 2 or 3 times where on a year-on-year basis, it may have barely contracted a little bit, but in usual recession, services consumption doesn't fall at all. And in this time, it absolutely collapsed. And services consumption is 2/3 of consumption and half of GDP in the United States. So you have half of the economy that basically isn't very cyclical, never really falls sharply, collapsing. That's very different, obviously. The policy response to that included all sorts of useful monetary policy measures, often learned from the 2008 experience or relearned in the 2008 experience. But I think the innovation in the US case was the checks, the stimulus checks. But I would argue that the stimulus checks even may be a little overrated in terms of affecting expenditure patterns in the US, which, like global expenditure patterns, are largely characterized by a rotation out of services spending, through distancing and into physical goods. So that was supercharged in the US by the checks, but not caused by the checks. And then as vaccines have come out and distancing has been slowly reduced, we've had all sorts of abnormalities in the data. The extreme demand for goods has pushed many goods, into basically demand past capacity. And so we've had huge spikes in inflation for certain items. There's a few services also that saw the same thing. And so we've had a large spike in inflation, largely driven by capacity constraints, often called supply side shocks in the media. And in some cases, actual capacity has been reduced. But in most cases, you actually have demand simply exceeding, normal-ish capacity and inflation adjusting in a usual way amid a bunch of monetary and fiscal stimulus as well. And so where we are now is we're beginning to unwind all of this. Month-on-month changes in inflation are moving more toward normal. goods inflation, should be falling sharply in year-on-year terms as we look ahead. The most powerful stimulus measures are being withdrawn. The Fed is ready to taper. Other central banks are tapering. A few have hiked rates. We are in the normalization now. Services consumption hasn't fully normalized. In the U.S. case, a lot of other countries, participation has not normalized yet. So the key thing here is, if you're thinking about the economy, don't choose one or two indicators. Notice that it's behaving in odd ways, compare it to past recessions, and tell a story based on extrapolating what's going to happen in that indicator based on past recessions. The key here is to understand what's happening holistically, that it starts with distancing and everything else I just mentioned, and you can kind of see phases of this moving forward. There's some key questions about whether the asset price gains that we've had are going to come back, the exact pace of inflation normalization, where inflation is going to end up, what happens with fiscal policy next, and will participation in the US come back? And could we have a burst of participation at some point that brings us back quickly, something we've never seen before? So there's still a lot left for us to learn, for us to see. We're still going to have very abnormal data in the next 12 to 18 months. We're still going to have people focusing on too few things and jumping to, basically extreme stories on the basis of that. But we're fighting through this, and it's a unique experience, not to be compared with past cyclical slowdowns.
Cool. So a very humble attitude with a fair amount of optimism. David, do you want to give us your view on this?
Sure. I think, I guess I've got a somewhat different take. You know what? I did my PhD in economics, I don't know, time ago. By the time, let me tell you that, neoclassical economics was still very much basically the dominant school of thought in economics. Now, obviously, over the last 20 years, Keynesian economics has taken over. It's now basically reigned supreme. And the reason is very simple, because every single one of the recession in the United States the last 20 years has been brought on by a negative demand shock. I mean, think about this. You had basically September 11, bursting of the IT bubble. You had basically the Lehman collapse, which massively curtailed the supply of credit. Therefore, it was a massive negative demand shock. Therefore, in the face of negative demand shock, the right policy response should have been and would have been basically, expansionary fiscal and monetary expansion. Okay, because when you have a negative demand shock, as you remember, the demand curve shift back to the left, and that's deflationary, and that gives you plenty of room to ease policies. In my view, COVID was the first negative supply shock we've ever seen, at least in my memory as a working economist. Certainly, we haven't seen this since the 1970s. Okay, a negative supply shock basically moves the supply curve to the left, and then that means it's inflationary. Okay, and therefore, I would argue the policy response should have been very different. Now, unfortunately, because people who don't know economics like Janet Yellen and Powell, all they remember is, wow, you know what? When you have a recession, you're supposed to ease basically fiscal and monetary policy. They went in, especially fiscal policy, they went crazy. In fact, the only thing, I think the only good policy the U.S. undertook during this entire time was actually by Mnuchin, who actually I think will go down in U.S. history as being one of the great, Secretary of U.S. Treasury, because what he did was PPP, purchase basically the Paycheck Protection Program. Because he understood, because that was exactly what you needed to mitigate the negative supply shock, because all of a sudden, all these companies about to go bankrupt. If they all went bankrupt, that would be it, because it would be very expensive to bring them back once a company goes bankrupt. So he basically helped these companies stay alive by helping them basically pay wages. That was the right policy, but everything else was a mistake. So especially I thought that basically Yellen, being the architect of the $1.9 trillion fiscal stimulus package that was passed earlier this year, that was completely irresponsible. Because again, this is like economists. I've always said, you know what? Economists are a little bit like doctors until the 18th century. Until the 18th century, 90% of illnesses were being treated in Europe by blood bleeding. In fact, George Washington most likely was killed by his doctor, okay, because his blood, half his blood was gone, and he was probably having a small virus, okay? And I sort of feel like this heavy-handed fiscal and monetary policy response to basically counter what is ultimately a negative supply shock is absolutely the wrong policy. It's irresponsible policy. And now Janet Yellen tells us the new fiscal spending is anti-inflationary. I think that woman needs to go. Either she doesn't know economics or she thinks we're all stupid. And thank God, I don't think we're all stupid. But be that as it may, I do think that therefore for that reason, I think this inflationary business is a concern because I think that single most important negative supply shock in the system is not goods market. I don't care about used car prices. Used car prices are going to come down, no doubt about that. But I think there's a massive negative supply shock to the US labor market. The fact is that, you know what, all these people there are all these jobs, and yet, hiring pace is relatively low. It's because there's a massive skill mismatch that has been created by the pandemic, okay? That is tightening labor market. The fact is that labor participation rate among women has gone down because until now, there's no vaccine for children. And frankly speaking, as a grandfather of 4 grandchildren, I'm not going to allow my children to get vaccinated, basically at the age of 5. Believe me, and most Americans will be completely against it, which means more women are going to stay at home in order to look after the kids. So there are a lot of, we can go on and on talking about this, but in my view, the unemployment rate in the US is probably closer to 2% than it's close to basically 5%. So from that point of view, I think that US will have to tighten more. And I think that's going to be ultimately the story of 2022. Anyway.
Cool. That's very provocative. So Jonathan, you want to follow?
Yeah,
up
so
on that?
that's covered a lot of ground. I'm not so. Can you hear me? Okay.
Yeah, perfect.
Okay, great. So those are not just provocative arguments, but both James and David have laid out a lot of elements of what's going on. Obviously, this has been a pretty unique shock, right? I mean, the speed, the magnitude, the global nature, all of it, exactly right. I mean, this is not something we've all had in kind of our working lives to grapple with. And I will say, when you initially posed the question, even before David spoke, I do think that one of the most interesting and unique aspects of this episode is the central role the supply side is playing, right? I mean, whether it was coming out of the early 90s, following saving the loan crisis, a lot of other things going on in the U.S. economy. It wasn't just 9/11 with the bursting of the tech bubble, follow on from the Asian financial crisis. If we thought about emerging from the last few recessions, we were all waiting for aggregate demand to come back to absorb the slack and that to sort of push inflation up. Right now, the Fed, we as economists, et cetera, it's the opposite. We're waiting for the slack to come back and bring inflation back down, which creates thorny problems for policymakers because it does then sort of ask questions about what the right tool for the job is. I mean, we could debate the fiscal response following the pandemic. I've got some sympathy for David's arguments, but at the same time, there were elements of the plans that didn't want the negative supply shock to turn into a negative demand shock, right? The Paycheck Protection Program, but also, there were other people being thrust out of work that you might want to fill in the cracks. And also, right now, it's not clear that raising rates rapidly would necessarily solve the supply constraints underway. If what we need is more investment in capacity or for people to return to the labor force, it's not quite clear that hurrying up to raise interest rates is necessarily the right tool for the job. It would be the right tool for the job if the inflationary pressures start to morph into inflation expectations, and do so in a way that starts to threaten the central bank's credibility or unhinge or create feedback loops. But that role of the supply side is very unique, for all of us. When I think about what's happening, sort of in the U.S. labor market, to pick up on, sort of what David was talking about, it's a microcosm. There have been a number of stresses that have emerged given how robust aggregate demand has met up against, supply constraints, whether it's the chip shortage, whether it's, exposing the bottlenecks at our ports and our domestic transport sector and the global shipping sectors, in addition to labor supply. I mean, there are a number of dimensions of it that have come under stress. But I don't necessarily think that, we throw in the towel. There's certainly been a massive negative labor supply shock, but I don't think we throw in the towel on, nobody ever returning. I mean, of the drop in the participation rate to Friday's employment report, almost 2/3 of that drop are individuals aged 20 to 54. 2/10 are over 65. We can imagine that, they are permanently shocked. There's certainly a long literature in labor economics that looks at how persistent negative shocks are for older workers. But it's very difficult to think that this bulk of workers 20 to 54, some may have non-wage income, some may have spousal income. It's very difficult to think that they are permanent exits. If you drill down into the demographics of them, there's still some COVID fear. Yes, childcare is probably an issue, although that's actually hard to see in the data. But it's a very intuitive reason. I mean, we also see that those people out of the labor force actually are responding, saying they want a job in the household survey in the US at a higher rate than pre-COVID for the people out of the labor force. So, I mean, there are, as the pandemic subsides, as the virus abates, we're certainly on the road to, additional treatments, whether it's, Pfizer's pill announcement or vaccines or booster shots. We certainly seem to be on a way to getting the virus to abate. Obviously, that's a risk, but I really wouldn't throw in the towel on the ability of 20 to 54-year-olds. Difficult to match back. There could be some hysteresis, but they're really, I think, too many of them and too young to think that we don't get some supply side response. And as we rotate consumption from goods back into services, that will also alleviate a lot of the tensions on the goods supply chain, as James was alluding to as well. So I kind of agree with David. I think that, one of the really unique aspects of this has been the, central role of the supply side, which is not something we've grappled with for some time, but I'd be a little bit more optimistic about how that might resolve itself over the coming few years.
Cool, great. I think that gives us a fantastic spectrum of views. And seems the focus here is on the supply side and how persistent that will be and how that will affect the kind of future of the recovery. So I think, to be fair on both sides of the arguments, I think, yes, we do see more people or increasing number of important policymakers acknowledging, the persistence of the supply bottlenecks. For example, Powell in last week's press conference did acknowledge maybe we shouldn't compare today's labor market and expect that to recover to kind of late 2019 level, just to be open-minded about kind of the partial recovery in labor supply. But at the same time, US and most part of Europe and developed economies, the market-driven economy, the market-based economy has an important tool to recorrect and adjust the demand and supply side imbalance, which is the price, right? The price signal is important. When it goes up, it kind of pulls the supply in. So kind of within this kind of both sides may kind of resolve themselves in a way or both sides have to compromise a little bit. So what do you guys think is holding us back in terms of the recovery, the pace of the recovery? Kind of what's stopping us kind of to progress, and why we are still kind of having a lot of kind of anecdotes that seems unresolved. Depends on what areas you're looking at. Maybe Jonathan, you finish first. Kind of, do you want to kind of follow up more a bit on that side? Is kind of help us to understand kind of what's holding back, and kind of what's your kind of time horizon of kind of the supply side being constrained, and also some part of that being resolved.
I mean, I think, I mean, we could point actually, I think, to a number of different issues, but I think the pandemic itself, I think, is really central, right? And the virus itself is still really central. I mean, if you think about why we're not traveling, why we're not back in offices yet, if you think about, why we're not, pursuing a lot of the same pursuits that we used to pursue, some things are going to be fundamental change, but many of them are still because we're resisting, being in public. James had talked about the central role of social distancing. I really think that is still, a really important reason. I mean, David also mentioned, are you going to get a 5-year-old vaccinated? And a lot of parents might be hesitant. But as the virus abates, right? I mean, as you consider things like, actually reaching herd immunity, and you think about all of the new therapeutics that are being rolled out as well, that increasing comfort and safety is really going to allow people to feel much more comfortable in having their kids at schools and being able to use public transportation. Many of the things today that people are avoiding, and we see that to some extent in surveys. Our evidence lab has run a survey of, sort of trying to decompose the dimensions of, how afraid people are of COVID. And that really does seem to be playing, a real role in the lack of re-engagement, including return to work. So, so I look at, the virus abating as kind of playing a key role actually in helping to free up, both the consumption patterns we see, and that in turn, many of the supply chain bottlenecks, as well as starting to work towards bringing down actually, the price growth that we see, in the current inflation data. So I'll stop there, and curious what my other panelists, how they're going to answer that question.
Sure. James, you focus a lot of energy on the supply chains and the supply side of the economy. Do you want to kind of follow up on that?
Yeah, I mean, I think there's multiple things. I mean, on the good side, we've seen, for example, huge demand for electronics. The electronics sector uses huge amounts of chips. One electronics firm uses as many chips as almost the entire automobile sector. They were going to get their chips. They got their chips. The automobile sector didn't. We've had inflation jump and all sorts of things related to autos, including used car prices, for example, which actually is a service, not a good. Over the next year, demand for electronics globally will be weaker. Less chips will be used by the sector. Capacity and chips will slowly come back on. The price shock and all those auto-related things will start to reverse. We may end up with a chips glut by 2023, 24. And these things will work themselves out. This is the spaghetti bowl, as I call it, because every line is in an unusual shape, working its way through this specific shock. The labor market thing is a little different. I mean, I would stand my ground here and say services consumption is half of GDP, and few of us have been able to consume services as usual for the last 18 months. That's demand shock. There's a supply shock too, but the fact that we were sitting at home, not going to restaurants, not traveling, that's a big demand shock. it's because of the pandemic. So demand fell, supply fell. And it happened in interesting and complicated ways. I think as we are returning now to consume services, labor hasn't fully returned to services yet. The global side of this is important. Canadian measures of participation have already reverted to pre-pandemic levels. Wenjie, you told me that. You showed me that chart. But
I can even tell you after Friday's new number,
okay.
prime age participation actually increased further. And
right.
I think that's a sign that people are willing to come back to work. And
right.
Yeah.
So U.S. participation internationally actually is lagging a little bit for reasons that I don't think we understand. I don't think it's because of policy. The vaccines are available in other countries too. I don't think we really know how and when participation is going to come back. I mean, my view has been for years that because of demographic and structural factors, the low end of the labor market was moving to a tighter state than it has been for much of recent decades, and that we would finally see better wage growth at the low end as a result. And we were seeing that relative to wage growth in the rest of the distribution prior to the pandemic in 2018 and 19. And my view is after the pandemic, that's likely to continue to be the case. And it may be that we don't get a full normalization of participation and labor supply even as the pandemic is ending. And that exacerbates that a little bit further. And that will shift maybe a little bit of the labor share higher. Maybe it will affect some business margins. Maybe it will ultimately lead to tighter monetary policy because of this. But I would separate somewhat the normalization paths of the different variables we look at from our views about just how tight the labor market will be when we're truly in a post-pandemic economy, which is a while away. And I would be careful about overemphasizing the supply side because I don't know how much participation is going to rebound in the next 12 to 18 months. I think it will go up. I don't know if it's going to get back to pre-pandemic quickly as it has in some countries. I agree that that's very central to what happens. But if it turns out that participation is 40 basis points below what we would have hoped, I'm not sure it totally changes one's worldview. So I think carefully looking at the data leads to somewhat more measured views on these things.
Sure. I think I just follow up a little bit on the Canada situation. It's just it is the country which has a very different set of policy responses compared to the US. I think that's second to David's view, which is the schools have kept open for a long time there, and the unemployment insurance policy has been less generous and designed in a way encourage less voluntary job exits. So I think those factors helped to support a labor market participation, meaning people want to join back to the labor market and find jobs. I think from James and Jonathan's discussion, I think it kind of focuses on a lot on the the development of the COVID situation and how the infections is going to change and how people's perception and the responses to that will be. So I think maybe that's an area that David wants to comment on. But I see David is raising hand. I'm sorry to drag along a little bit. So yeah, please give us your view.
I think we all agree about one thing. It comes down to COVID. In fact, you know what? We're economists. We sit here, basically we're supposed to concern ourselves with economic forecasts. But I think, the truth is today, unless you take a view about COVID, you know what? Everything else you're going to say is based on pure bullshit, right? Because at the end of the day, unless you know what's going to happen to COVID in the next 6 to 12 months, you have absolutely no idea what you're basically predicting. Now, my view is very simple. I'm not I'm not a pandemic basically specialist either, but unfortunately, you know what? We're in this business of making forecasts. You got to basically jump in. Especially given doctors simply have done a poor jobs in terms of forecasting the outlook for COVID. So that's where we have to start, in my view. My view is this: in the last 18 months, about the only thing we've learned in the last 18 months about this pandemic is the fact that it's very prone to mutations. And then we've had alpha, beta, gamma, delta, and so on and so forth. So from that point of view, I have no idea if, we won't get another basically, whatever variant that's going to be more immune, whatever it is. So I think this is a major risk that we cannot simply rule out. But to me, even forget about that for a moment. I'm generally, in the last month, I've been pounding the table, forecasting that we are literally on the verge of the 5th wave of COVID, which I remain absolutely convinced about. And the reason is very simple. And this is why I think Americans are completely in complete denial about what's really going on. I'm living in Israel. Now I left Wall Street. I've now settled in Israel. I'm having a great time. Now, it's very interesting because this summer, when I ranked the 38 OECD countries according to their new COVID cases per capita, the 3 countries that stuck out were Israel, United Kingdom, and the United States. Okay. Now, it just happens I'm a US citizen, I'm a UK citizen, I'm a legal resident of Israel these days. I was still pondering, like, what the hell? What do these 3 countries have in common? One is a country as big as a continent, another country is an island, another country is a sliver of a piece of land in the Middle East. Why should they be heading off, experiencing simultaneously the worst basically outbreak? Well, let me tell you, having done some serious econometric analysis, I can tell you the reason I found. The reason why these 3 countries experienced the worst outbreak of COVID this summer was because these 3 countries were the first to vaccinate their population. Okay. I think the experience of these countries show that because they were the first out of the gate to vaccinate their people, they were the first to see, the effect of the waning effectiveness of the vaccine. Okay. Now, that's where all these 3 countries have in common. Because meanwhile, Israel, in the last 3 months, has been giving out the 3rd booster to anybody who wants one over the age of 12, including myself. I got my 3rd booster already 2 months ago. As a result, the number of cases in Israel has collapsed, completely collapsed. The UK has decided to give out the 3rd booster to everybody over the age of 50. The US, the FDA, in my view, screwed up big time when they decided to only give out the booster to anybody over the age of 65. As a result, according to my calculation, 70% of the fully vaccinated individuals in the US are now at risk of losing the protection from the vaccine as a result of the waning effectiveness, because they got their basically vaccines, the 2nd vaccine, basically more than 6 months ago. Okay. And then the same thing is in Europe. Now, in my view, this is the reason why you're going to see the 5th wave. In fact, if you look at the global number of cases, it's been edging higher gradually over the last 2 weeks. In fact, Europe, almost all major countries are now seeing an uptick because what I'm telling you right now. Now, it's true that, there's no doubt if you're fully vaccinated, you're less likely to die from COVID. That we know. We even know that from Israeli data. But I can tell you as late as August in Israel, 60% of the people who are hospitalized were fully vaccinated individuals. In other words, when you have a large number of people who are getting sick, even though a fewer percentage of that people are going to die, if you have a large enough base, you're going to get a large enough of people dying or basically being hospitalized. In my view, Biden, US is the worst situation. Because guess what? Because in my view, Biden and the Democrats completely politicized the vaccine. We all know if it hadn't been for Donald Trump, there wouldn't be vaccines. The fact is that Donald Trump gave money to Moderna, he gave money to AstraZeneca and Johnson & Johnson. In other words, 3 out of the 4 vaccines that are currently available right now in the market basically got money from basically the Operational Warp Speed. And by the way, Donald Trump only gave money to 5 of them. So that's a very high hit ratio. But because the Democrats from the very beginning of last year trying to politicize the vaccine, the US today has the lowest vaccination rate of any country. And by the way, it's not all white supremacists, by the way. We know that blacks and Hispanics have much lower vaccination rate than white people, and they cannot all be white supremacists. And then what's going to happen? Let me tell you this the next few weeks. If I'm right, the fifth wave is going to raise its ugly head in the US. In other words, more and more vaccinated people are going to get sick. You know what? That's only going to embolden the anti-vaxxers who are going to say, you know what? This shows that this is the reason why I never got vaccinated. I don't want to get vaccinated. And guess what? More of these people are going to quit the job market. I think you're going to start to see that in the October data, by the way. What about the 10,000 New York City employees who called in sick over the last week because basically they don't want to get vaccinated? You don't think that's going to have a major impact? So in my view, the politicization of basically the pandemic, the vaccine in the US by the Biden administration, especially in the lead up to the election last year, and the fact that the FDA decided not to give out the third booster to everybody, means that the negative effect on the US labor market is going to be much longer lived than people realize. This is the big difference between Canada and the United States. That is the number one difference between Canada and the United States. This is why Canada, the vaccination rate much higher than the US. There are not that many anti-vaxxers because precisely the Democrats have really shot the US economy right in the eye. Now, let me tell you about this negative supply shock. The other country that has the same problem in a very different way is, of course, China. Because when you're talking about negative supply shock, you got to talk about China because that's where we're making stuff. China continues to have a zero tolerance policies when it comes to the pandemic. Now, I'm sorry to say this, that's a huge mistake. Even Australia and New Zealand have now basically decided, you know what, it's too costly to keep the shutdown. The Chinese have decided, you know what, we're going to shut down everything if necessary just to basically have zero. So from that point of view, I've always said China got lucky last year because whatever virus that hit China at the start of last year, it was much less lethal, much less contagious. If China was able to eliminate it so quickly, it was because it was easy. But Delta clearly is not so easy. So what I'm saying is the fact that China is still pursuing zero basically tolerance towards COVID, and the US, because of the politicization under the Democrats, I think the negative supply shock, at least the next 6 months, listen, I'm not in the business of forecasting 3 or 4 years out. I'm not interested in 3 or 4 years out because nobody knows what's going to happen 3 or 4 years out. All I know is the next 6 to 12 months, I think the dynamics that have been unleashed are going to be here to stay. And whether the Fed and Janet Yellen like it or not, this is the point.
Cool. All right. So I guess it's an important point that whether, this the fifth wave of outbreaks would bring the same level of restrictions to people's behavior or not, giving so many vaccines distributed. I don't have a view there, but I think that's kind of debatable. I think let's move on to the inflation. I see some questions from the audience which are addressing to inflation. And I think we discussed enough the demand versus supply. Inflation is a price. It tells us the balance between demand and supply. We are running really high record inflations here, higher than anybody probably, most of the people in the audience will remember in their lifetime, in the US and in Europe. So what's our outlook and in terms of inflation, bringing in your kind of balance between the demand side and supply side, the dynamics. I think Jonathan, you want to give us a view for that?
Yeah, I mean, I think I might be a little bit the outlier here. Yeah, so we've got actually really pretty strong inflation headed into the end of the year. So it's not going to relent. We sent out our CPI forecast this week. It's going to be, above consensus again. But we also think that this massive wave of inflation is going to crest as we head into 2022, right? So a lot of the prices we're watching rise right now, we would expect to stop going up, and some of the pressures to ease. I mean, a little bit for the story we were telling or I was telling earlier on, with some relief from the supply side, as well as the rotation of spending from goods back into services, alleviating some of the pressures on the goods supply chain. But we then have a fair rolling over by the middle of next year. When price levels stop going up, inflation, which is the growth rate, goes to zero. So we're not expecting inflation go to zero, but we are expecting some pretty weak outturns in core PCE inflation, for example, as we roll through the middle of 2022. And we would expect inflation below 2% on a full year basis next year. So, we are a little bit more in the camp that, some of these supply pressures are going to ease. We certainly see the supply pressures putting a lot of upward pressure on inflation into the end of this year through December. But as things like commodity prices hit tops and some of these other pressures ease, we see a pretty reasonable softening in growth rate terms as you go through 2022.
Cool. So can I just follow up? Does your view incorporate the kind of the upcoming fiscal stimulus and things like that? Kind of how do you factor those in? Like, things are changing fast.
Yeah, things are changing fast. So, obviously there are risks around the assumptions of the fiscal packages. The House managed to pass the infrastructure package late last night or overnight. That, as spending, is significantly more spread out than the packages we've seen, like the Recovery Act at the start of the year. So that infrastructure plan with its relatively slow spend out, we still are going to have a general contraction in overall federal government spending, even with the new fiscal proposals. So we're not looking at that infrastructure as particularly inflationary. And while it's probably not disinflationary either, there is hope that we could use some of that investment to improve things like our transportation bottlenecks. But the next big question really is the Build Back Better plan that's still being constructed. And they're front loading a lot of the spending. So, our ballpark is that adds, in contribution terms, essentially roughly a percentage point to 2022, 2023 growth, due to, the maintaining of the child tax credit and some of the other rollouts of the components, even with the fact that they are going to try to pay for a significant amount of that. But but we're still waiting to actually see what the plans look like, what kind of pay fors they do manage to coalesce around. There's been a lot of movement in the last few weeks, but whether or not these are final thoughts kind of remains to be seen. But that is actually already in our baseline view. For the most part, I mean, we'll see what we get and might adjust accordingly. But the inflation view really is more predicated upon seeing some easing of some of these pressures, along with the fact that a lot of these prices in level terms have had a pretty good run up, and it begins, in our estimation, to be difficult to see them to further push higher, at those same rates. So we'll see, but the fiscal packages are already incorporated for the most part. We'll see what they end up with into that view.
Well, that's an important distinction. The level of prices, it can stay high, but in terms of year-over-year change, it could actually come down because you're kind of losing some steam on the demand side and supply situation improve. I think that's important for most of us in the audience. I think recognizing that is important. So James, do you want to follow up on that?
Yeah, I mean, similar view, different path slightly. I mean, we know from base effects in year-on-year terms, core inflation measures in the U.S. are likely to be falling very sharply in the spring and summer of 2022. That's very important in terms of the Fed path and the talk, the narratives, the media on inflation. One interesting question is, we will probably see year-on-year inflation measures rise further in the next couple of months. Will it continue to rise in Q1? That's actually a difficult analytical call right now based on the month-on-month numbers falling out. But people are very focused on the specific path. My guess is once we're through all this and it's late 21, I think it's going to be 22. I think it's going to be a little higher than Jonathan said. So I'm looking more 2.2% for core PCE inflation at the end of the year. So it will have fallen a lot, but keep in mind, average core PCE inflation since 1995 is a tiny bit below 1.7. So 2.2, that's higher, significantly higher, actually. And I also think post-pandemic, we're looking at an economy with underlying inflation running at 2.2 to 2.4 in core and headline terms. And this is basically 5-year average, 23 on. And I think the labor market is structurally tighter. I think we do have some pent-up effects from all the stimulus, monetary stimulus, fiscal stimulus that we've had. I think under average inflation targeting, the Fed is unlikely to fight it as before. I don't think these stimulus measures we're having now change the story, but I think they, basically exacerbate tightness in pockets of the labor market. And I think those tighter pockets in lower income jobs is moving more cash to people who will spend it rather than save it, and help sustain higher prices for the basket of goods and services that defines the key inflation measures in the United States. And so all these things together lead us with inflation running, 50, even 70 basis points higher than the last, couple decades over the next 5 years. But the story in 22 is it will fall first, and whether it falls all the way so that it dips its toe below 2, I guess is an interesting question. We say no, Jonathan says yes. And just to give a nod to what David said earlier, absolutely. I mean, the pandemic outlook is gonna shape everything. The good news right now is that on high frequency measures of social distancing has been reduced a lot. So from an economics perspective, we are normalizing our behavior significantly. We're not quite there yet. And, I think with the existence of boosters and all these other things, and with school schedules normalizing, I do think we are returning to a more economically normal way of life. So even if we do have further COVID waves with fewer hospitalizations and deaths, I think this process can be unfolding in more or less the way I've described. And I would regard a new significant variant that completely changes that a total shock and surprise. But I would not say that that's zero probability. It's in the list of tail risks that we have to think about.
Yeah, for sure. I think people are hopeful with the latest news regarding the pill from Pfizer and the high vaccination rates. But nevertheless, there are high risks. And I think there's also one question from the audience regarding the labor participation rate earlier on, asking why that's the case. I think the popular argument for it is people are held back from the labor market because they have fear of the virus, which is important. And also the school children are not fully back in as before September this year. In the US, that's a big factor because that means the adults need to watch the kids. And also it's just, the general fear of the kind of environment and high paychecks, unemployment benefits, which is the benefits that the kind of unemployed US citizens get. That's a big factor holding people back. And then those are the kind of key issues here. I want to follow up with James that, suppose, we do have this kind of participation coming back, meaning more people joining in the labor force because all those constraints are receding. Kind of what does that do to inflation? Because I think on one hand, it kind of increases the supply of labor, which is putting downward pressure to wages. But on the other hand, it kind of creates new income from earning wage from a permanent job that gives you assurance about the future. So how do you balance those two factors?
Well, I think the short answer is, I think in the short run, if we did have a very sharp recovery in participation over, say, 6 months, it would be very positive for GDP and jobs growth, and would probably stimulate aggregate demand more than supply in the short run, and be a little bit inflationary, lead to faster hikes. Down the road, it means the labor market hopefully less tight. But I would just sort of characterize the participation issue a little differently. I mean, we have looked at those numbers very closely. The San Francisco Fed put out a paper at the beginning of the year saying, like, it's moms. It's not moms. If you look at the data now, there's actually been they sort of picked the high point when in volatile data it looked like it was basically more women and more moms that were not participating. It's actually more balanced now between women and men. And if you cut it by and this is the lack of participation, if you cut it by income, it's lower income people sitting out more, but there are a lot, and it's the 25 to 45-year-old population specifically, which has the worst participation relative to what you would have expected, where the surprise on the downside is concentrated. But if you cut it into parents, non-parents, the non-parents are just as bad. And again, when you compare it internationally, a lot of countries with a lot of similar attributes to the US are doing a lot better. So sometimes you just have to say the data don't tell us a clear story about this. So I think that's very important. Yeah, I would think it's good for growth in the short run. It would put some downward pressure on some wage pressure and tight labor markets. Longer term have the opposite effect. But the data do not clearly reveal the answer on what's going on in participation right now. I think that's very important.
Okay, that's fair. I think that's important. Recognizing we don't fully have a grasp of what's going on on the ground. I think that's important because that's also the monetary policy makers are telling us as well. I think I will turn to David, but in a slightly different way. I think we are talking about inflation. That's important because how much more inflation is going to have matters to Fed policy. And obviously, if the Fed is hiking behind the curve or ahead of the curve, gives a very different implication to the markets. I think I want to embed the inflation question in a Fed view for David. Is that if the Fed is trying to keep its mandated target, which is flexible average inflation, that just means averaging the inflation rates across a period of time so that it's roughly on 2. So what kind of does it take for the Fed to do? How fast they need to hike or catch up, or are they kind of ahead of the curve already by announcing the taper? So what are you seeing there?
Yeah, so I think listen, I think that's an important question, obviously, because obviously inflation itself is going to be the consequence of the outlook for monetary policy. So from that point, we can't talk about inflation without talking about monetary policy, because they're going to be co-determined equilibrium basically set up. Now, let me tell you what the biggest takeaway I think I came away from the FOMC meeting last week. I think first of all, I think very conveniently, Powell failed to mention that there's a lot of uncertainty with respect to the outlook for fiscal policy next year. There is no doubt in my mind that one of the reasons why companies so easily pass on the increase in costs onto the consumers this year was because of the massive fiscal stimulus that was unleashed in the US economy. So that if you look at retail sales year on year, I mean, we've never seen numbers like this in 30 years. So from that point of view, there's no doubt that strong fiscal policy was the reason why we've had basically this inflationary shock in the system to a great extent. Now, we all know, so therefore the first question I think the Fed has to decide is what's going to happen to basically the social spending bill, the $1.75 trillion currently under proposal. This is my view. My view is very simple. I think the single most important takeaway from the election in Virginia last week is this. I looked at basically the 10 counties in Virginia that border on West Virginia. And I looked at basically the share of votes gathered by Youngkin and compared with what basically the Republican candidate got 4 years ago. It was off the chart. I mean, of course, these 10 counties to begin with are pro-Republican. 4 years ago, the Republican candidate got 71% average votes for these 10 counties. Youngkin got 78%, my friend. Now, let me tell you this. At this point, if I'm a Democrat sitting in West Virginia, I'm literally, my toes are shaking my boots thinking about 2022 midterm. I have to believe that even Joe Manchin has become very concerned about what this really means about his own political future in a state that Trump won by 30 points in 2020. In my view, the real consequence of the election in Virginia is that Joe Manchin, in my humble opinion, will at this point choose to change his party affiliation before he basically gives up on his red line over the social spending bill. And the way that Pelosi, in a very stupid way this week, decided to add back the parental leave, the family leave, the sick leave back into the spending bill tells me that there's a massive collision course about to unfold, okay, between the moderates and the progressives. If I have to basically guess, I think, and this also, the Republicans probably are laughing at this because this will give them a lot of ammunition to decide to basically hold their ground on the debt ceiling, which becomes binding in 4 weeks. So my view is that right now there's a lot more uncertainty about the fiscal outlook in the US in 2022. I would say all else being equal after Virginia, there's more downside than upside risk for the economy going into next year because the fiscal impulse will be even smaller. Now that, therefore, that's Powell's position, I think. He doesn't know. The second thing about inflation is who the hell is going to become the next chairman of the Federal Reserve, right? I have no doubt. I have absolutely no doubt. If listening about this, we know that Powell wants this job again. I have no doubt that Yellen would love to see his back. I have no doubt that Yellen is probably rooting for someone like a Lyle Brainard or basically even Mary Daly to replace basically. Because the last thing she wants to see is the Fed start hiking rates and offsetting the impact of any fiscal stimulus. Especially she's telling us that fiscal stimulus will be anti-inflationary. So my view is very simple. However, I'm not that worried about this. This is why, Powell was trying to sound like dovish because all that was probably for Yellen, who has probably the most influence on Biden in terms of who's going to be the next chairman of the Federal Reserve. But my humble opinion is that, again, Joe Manchin is my hero right now. I think Joe Manchin, over his dead body, he's going to let someone like a Mary Daly become the next chairman of the Federal Reserve. So my view is that Powell is going to get the job. Okay, I think the fiscal pact stimulus will be smaller than what's generally expected. And as a result, we're probably going to see more aggressive, basically, tightening, okay, relative to the underlying growth momentum in the first half of next year. And I think that's why real yields are going to be much higher. I think long-term real yields especially are much too low right now, 10-year real yields. Obviously, the big uncertainty, which I'm surprised Jonathan and James didn't talk about, is the element of rental inflation. Rental inflation is more than 30% of core PC, it's almost 40%. It's the single biggest chunk. We know that rental inflation, all anecdotal evidence suggests rent is going up at a very fast rate. We also know that rent is sampled very slowly by the BLS. I think next year you will see rental inflation picking up. That's my gut tells me. Although they might try to basically massage the data, I don't know what. So from that point of view, this is the reason why, yes, goods inflation are going to collapse next year. But I think rental inflation, which is 40% of core PC, I suspect it's going to accelerate. How much is going to offset this is difficult to say. But clearly, I think that is going to be the major driver of monetary policy next year.
All right. I think that gives us a lot to think about on the inflation and policy interaction part. I think that's it's important to recognize the rent inflation. That's a big part of the work any kind of economics team will very drilled into. And just take Canada for example. Their house inflation, which is sampled very quickly, is actually taking majority of the inflation already. It's not goods, it's rents and house prices. So I want to wrap up this session by asking the very last question. What's the takeaway? Giving us some investment implications. What obviously we have a divergent views in terms of growth and in terms of inflation. I think it's worth sampling every panelist here. Just give us like a very high level type of investment views. How you have talked with your clients or institutions about your investment views. I think that's James. You want to start?
Sure. Well, we think stay invested in risky assets and in equities in particular. Yields are going up. Uncertainty about the Fed outlook in the short term at the moment. We still have no hikes in 22, but conviction is declining on that one. But I would say 23 to 26, I think we're going to get more hikes than people expect. So I think this 2.5% long-term rate that the Fed has, or this sort of 180 that the market seems to be pricing, I think either of these numbers are too low. So I see a steeper hiking cycle in general, and I think through elevated inflation this year, even if it comes down, or in the next year, I think people will start to worry about some risky assets on that basis. But it's really about future increases in interest rates rather than an imminent change. So for the moment, we think you could still own risk. But the bottom line is that the net worth to GDP ratio in the U.S. has risen by about 80%. In other words, we've added 80% worth of GDP to household net worth this year. And so you have to worry about risky assets falling at some point. I don't think we're on the verge of that. But I think we're going to have a lot of macro volatility ahead, higher rates. I think inflation falls this year, but stays high in the years to come. I think rates go higher than expected in the years to come. And the lively discussions that we can have on many things following this pandemic, I think are going to continue to be the case for a number of years.
Cool. Great. Stay with equities. Jonathan?
Yeah, I'm not going to, I'll differ a little from James, but sure, equities stay invested, and, we see yields going higher too. Not, maybe as high. We've got a year-end target for the 10-year at, 180, but we certainly are sympathetic with the idea that, the structure of rates looks a little low. And to James's point, we also, since we have, since we have reasonably low inflation next year, we don't see any 2022 hikes. And to David's point, we actually, our read of some of the, highest frequency rent data actually shows some slowing, which, gives us a little comfort with where the trajectory of OER is headed. But going back to James's point about the conviction, I don't think it's a conviction about rate hikes for us. It's just that, the taper kind of buys the Fed, and Powell said this actually backhandedly in his comments Wednesday, how they're going to learn a lot about the economy in the first half of the year. They've kind of got this window to evaluate just how transitory these elevated inflationary pressures are. And if inflation doesn't come down, as we expect, certainly the Fed could turn really quickly towards raising rates in 2022. But we are expecting some easing of inflationary pressures, and that keeping the Fed on hold through next year. But they do, in sympathy with kind of what James is saying, the choice to us looks kind of bimodal almost to some extent.
Great. David?
So I think just a couple of things. I don't have a strong view about nominal yields. I have a much stronger view about real yields. Right now, basically 10-year US real yields is sitting at minus 1.1%, which is near all-time low. To me, that doesn't make any sense, especially given that, tapering is about to start. You could argue that, the non-farm payroll numbers this week tells us the U.S. is, gaining momentum and so on and so forth. I think real yields are much too low. Especially given the long-term fiscal outlook. So I think, at this point, selling tips, expecting it to underperform, that makes a lot of sense. regardless whether you have a strong view or not about basically nominal rates. I think, there's also no doubt in my mind that I think China is set to slow a lot, okay, over the course of the next 12 months. So I think the Chinese slowdown story is going to continue in 2022. I think that's very bullish for the dollar longer term through next year. So I think the dollar is going higher, especially against Europe. I think the US real yield should be higher. And finally, what I really like is energy price. Because I think the single most important thing about because my view is that the last 10 years, the single most important development for the global economy for the US, which made me very bullish for the US until recently, was US energy independence. US oil production went through the roof, which helped the world to basically meet increasing oil demand from places like China and India. But because of the Democrats, because of Biden's policy, US drilling activity has been massively lagging behind basically the surge in price this year. Because companies cannot even get credit from like some Bank of America, JP Morgan to drill because Bank of America, JP Morgan don't want to have protesters camping outside their headquarters saying that you guys are abetting basically a carbon emission. As a result, production response is much slower than would have been otherwise. Meanwhile, the Saudi just basically told, Biden to pretty much fuck off, okay, when it comes to raising production. So my view is that I think high energy prices are going to be here to stay. For that, I like owning oil majors. Oil majors right now are giving you 5.5% dividend yield because of ESG. Nobody wants to touch oil companies. To me, in an environment, very, very low yields, oil majors make sense. I'm not saying it's going to go up in capital appreciation, but as a dividend play, to me, that's very attractive, basically. So I like higher oil prices, higher basically oil stock price, higher US dollar, and higher US real yields.
Great, fantastic. That's a good range of ideas to think about. Okay, look, we are running over time. I really appreciate the panelists' very engaged discussion. Thanks for coming here to share your thoughts with us on a weekend weekend day. And also want to thank all the audience for staying engaged. There are good questions that we don't have time to cover. For the people who want more type of content like this, I will tell all of you there's another treat tomorrow, 8:40 a.m. New York time and 9:40 p.m. Beijing time. Note there's a clock change for the US audience. Mr. Jason Furman, who is a top policy advisor to Barack Obama, is going to give us keynotes address tomorrow morning, sharing some of his views. So stay tuned and come back if you're interested. I'd like to thank everyone again for this great discussion, and that concludes our panel today. Thank you very much.
Thank you.
Thank you.